Let's bring in Point72 Asset Management Chief Economist Dean Maki. He joins us on the CNBC Newsline. And Dean, I mean, if you lay it out there, it feels like the eat whatever you want and never gain weight economy, right? Growth better than anticipated, inflation coming down faster than the Fed had projected, and now the market position for the Fed to essentially formalize an easing bias. Can we have all that come Wednesday?
Yeah, I think it's sort of the best the Fed could really have hoped for at this point. They've wanted inflation to come down. They thought it might take a lot of pain to do so. But in fact, actually, growth has sped up rather than slowing down, accompanying that lower inflation. So I do think the Fed's in a very nice place right now.
And so how do you think, in practical terms, on Wednesday, the Fed will try to convey the message of its current stance? I mean, you know, a lot of Fed officials, of course, don't want to be too proactive in saying we did it, inflation is taken care of, yet they still have a tightening bias, and the markets are somewhere around 50-50 for rate cuts beginning in March. So what's Powell's job on Wednesday?
So really, I think Powell's job is to keep the market roughly where it is. He doesn't want the market to fully price in a March cut. He doesn't want to fully price it out either. So I think what the Fed will do is take away that tightening bias. They won't have a particular bias at this meeting. I think he will just speak cautiously. He'll talk about how they're going to respond to the totality of the data. They're going to be data dependent going forward. And he really wants to just keep all their options open.
And I suppose in this instance, the data that matter really is just inflation at this point. I mean, it seems as if we're past the time when they were targeting other secondary influential factors that would get inflation they thought where it needed to go, correct? I mean, can we have, 3.1% real GDP economy in the fourth quarter, if that's what we really had, and still have inflation go the right way and the Fed say, we might back off?
I think it's an open question at this point. The Fed's models tell it that policy is quite restrictive right now, and that's why they're thinking about cutting rates this year. On the other hand, the economy is not acting like the Fed's really restrictive right now. The economic growth has been speeding up, not slowing down. And in fact, if you look at the past, when inflation comes down, that tends to be accompanied by strong economic growth, not weak growth. And so the risk for the Fed is if they do what the market's saying and cut multiple times this year, 5 or 6 times like the market is priced in, and the economy is speeding up, that could tighten the labor market, cause wage growth to pick up, and cause an inflation problem down the line that they really wouldn't have had to create. So I think they're going to be a little bit cautious about cutting aggressively this year. They want to see some evidence that policy is actually slowing the economy down, and we haven't really seen that in any significant way so far.